I'm Gwen Preston of Resource Maven. Nice to see you here in Toronto this morning. It's funny, we do these conferences every few months, and so I always have this hope that I can take the presentation that I made this time only 6 weeks ago. I'm like, surely it's got to still have some useful. It didn't have much that was useful, so I had to basically start again. And that ended up being sort of what I'm talking about today is what has changed in the last 6 months in the sort of macro setup, and why does that matter, and what does it mean for looking forward? I'm just going to point this in a bunch. There we go. Apparently, if I point it over my shoulder to the back, I think that was probably just happenstance. But anyways, I could have titled this presentation, "What Happens If the Plane Just Keeps Flying?" Because we've had this endless conversation, truly endless conversation for the past year and a half, ever since the Fed started really raising rates, about whether the landing for the economy following the rate hike cycle was going to be hard or soft. Hard or soft, hard or soft, that has been the entirety of the debate. There was no question that there would be a landing, that there would be some form of a recession. The debate was only about whether it would be a soft one or a worse one, and a soft landing was generally thought to mean growth slows, inflation comes down enough, but importantly, unemployment only drops a bit. So people generally keep their jobs, which moderates the impact. And that setup would have been good for gold because there would have been some uncertainty about this recession and what it would all mean. But everything would just sort of carry on. That would have been actually a great setup for gold. For base metals, it would have worked really well. The hard landing argument was that this historic rate hike cycle was going to pull things down hard. Inflation would come down hard, perhaps too much. Growth would fall into the gutter, and employment would really go up. And of course, employment matters in terms of how hard a recession is and how long its impacts last, right? It all, especially in the North American economy, consumer spending is so important that employment drives recessions. Had we had a hard landing, that would have been great for gold because it is certainly known, perhaps more than anything else, to rise first and best out of a crash. We've seen that a bunch of times over the last 15 years. It also would have been a good setup for base metals for the same reason that the soft landing would have, which is that there are these very bullish fundamentals, supply-demand problems. And so if you just sort of get the crash over with and then move on, strong fundamentals plus the reality that investors like to ride real assets out of a crash, I think that would have worked very well for base metals. So those were that was the debate all through 2022. Anytime you went to any financial website, there was at least one article about whether the current data was pointing to a hard landing or a soft landing. Instead, the plane just keeps flying. So what happens if there is no landing? Now, before I even go any further into that, there will be a landing. No plane can fly forever, and rate hikes will certainly have an impact at some point. But right now, we are not there. We are in the plane just keeps flying situation. Now, there's data on both sides, and that's why the debate lasted so long. All through 2022, there was data on both sides. On any given day, you could go and look at data points, and you could use some number of them to argue for one camp or the other. Right now, certainly we have key yield curves that are deeply inverted, which is known to be a reliable recession indicator. We have pretty, world growth forecasts have been really cut. I mean, the World Bank cut its 2023 forecast to 1.7 from 3. So that's a very significant cut, right? These are not optimistic forecasts. Earnings per share forecasts are being slashed at a pace that has only ever preceded a recession. Okay, and then there's just the fundamental thought that the strongest rate hike cycle in history has to cause a recession, right? That's always been the thought. But instead, what we're living through is what I'm calling surprising strength, especially in the last few months and in these last 6 weeks since I last put out since I last created a presentation. We just keep getting things that look a-okay, right? I mean, wage increases are moderating, even while unemployment remains low. Like I said, unemployment really matters. If unemployment can remain low, that really moderates a recession. But the problem with low unemployment is that you end up having employers compete for employees, which causes wage inflation, and wage inflation drives all inflation, and then this is the vicious cycle. But right now, that's not what we're seeing. We're seeing that wage increases are easing, or at least remaining quite moderate. After surprise negative numbers in January, the February numbers for manufacturing and service PMIs looked fantastic. And so that's all fine. China reopening can't but help. We don't yet know how dramatic that help will be, how much stimulus that will be, how that will all play out, but it can't hurt, right? It can't add downside. The fact that we didn't have an energy catastrophe in Europe this winter, they were very lucky with the weather. That certainly eased some of the potential for chaos. And, a lot of the other softer things, air traffic, hotel bookings, restaurant traffic, they all just keep rising. So we're in this situation of surprising strength. So for now, strength is winning. And that's not what I said 6 weeks ago. I was like, okay, I think we're heading towards a soft landing. But right now, in fact, we're just in a plane keeps flying situation. For now, the data points are just fine. Like I say, this will change. There will be a landing at some point. But being too early in betting on things going sour is the same as being wrong. I mean, that's being too early in betting on anything is the same as being wrong, right? It's like betting on uranium 5 years before uranium actually goes. You just end up sitting on a lot of money and probably a bunch of losses. So if we are in this situation of surprising strength, and it's going to persist for some time, some number of months, half a year. I don't know how long this is going to last. We're in a data-dependent world. What does that mean for metals? What should metals investors be thinking about right now, given this surprising situation? I've kind of gone through what it means, and I've lumped them into 3 groups: the good, the bad, and what's really the fear of the ugly. And that's what I'll talk about yet. The chart here certainly shows that markets no longer expect rate cuts anytime soon, right? These are the 2-year yields on the Treasury and on the German Bund, and they have gone nowhere. They're back on an upward trend, and so we're just not expecting rate cuts anytime soon. So for as long as that persists, as long as we think things are strong and we're not in a pivot situation, what does that mean for metals? Well, I think the good is that base metals are doing just fine as investors accept things might be okay. And I think the second part of that statement, as investors accept that things might just be okay, that's where we have the potential for things to get better from here. If data continues to look good, if this surprising strength builds, and with more and more data points that look good, there ends up being some confidence in this surprising strength, then we could be in a situation where this base metals market that has to happen at some point could actually happen, right? We could actually, and whether this is like the big version of the base metals market or whether this is a smaller version of it before we have the other shoe dropping, is yet to be seen. But if we keep seeing strong data points, investors are going to be like, okay, this is where we are now. And in a good economy, we need base metals and we don't have enough of them. So let's do something about that and put their money to work there. And so we've seen a bit of that so far. If the data continues to come in strong, I think we will see a bit more of that. So I'm optimistic on especially copper in the near term, because if the data continues to come in strong. Gold doesn't get a lot of help from a great economy. That's not how that usually aligns. But it's worth noting that gold did incredibly well last year, despite very strong headwinds. And the 2 main headwinds being real rates just went boom through the roof, and the US dollar also went much, much higher, and yet gold ended the year even. So there's some fundamental support for gold there. There's an underlying investor interest in gold, probably because I just defined the current situation as a surprising one. So there is some what on earth is going on out there that persists, and I think that's probably one of the main reasons that gold did well last year and could continue to. And gold does like to go alongside other metals. So if we do get a broader metals market, then gold likes to go along with that as well, even if sort of on a fundamentals level it doesn't have to make sense. Okay, so that's the good, that if things continue to be good, then base metals are well supported and we can carry on with that, and gold could come along for the party. The bad is what I just said in part. Gold doesn't get any specific help from a strong economy. Gold prefers either a weak economy or coming out of a crash, some reason for investors to need hedging, and that's not what a strong economy is. So gold doesn't get outsized attention. I also sort of, on a more esoteric level, I wonder, in 2022, I was very heartened to see a shift to value investing. For the preceding decade, it had been all growth, 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 which is the kind way of saying that there was an obsession with meme stocks and fear of missing out, and buy big data just because everybody, or buy big tech because everybody else is buying big tech, and send valuations to the roof, and fundamentals don't matter, and let's buy, profitless unicorns and monkey NFTs. That was a real thing, right, for a whole bunch of years there. But in 2022, we actually saw a shift back to value investing. Value outperformed growth for the first time in a decade. And I like that because I'm a metals investor, and especially the base metals rationale is that it's all about fundamentals. We have supply-demand gaps, and these things are needed, and the prices aren't enough to catalyze new mine builds, and it's all about numbers. So I liked to see the shift to value investing. We've seen that reverse to some extent so far in 2023. There is, once again, interest in growth. Is this a, call it bear market rally in growth? If so, that's very understandable. I was just having a conversation this morning about how bear market rallies in things that have actually ended are very common. If you look back to the tech bubble of the late 90s, great example, right? I mean, that bubble ended, but there were some incredible rallies on the way down, and it's because people didn't want it to be over. And investors can create their own momentum to some extent, and I think that's what a lot of those bear market rallies are. That's a bigger picture thing that I'm interested in, that I'm watching. If you see a continued shift from obsession over growth stocks to more interest in value stocks, that will overall be better for metals. And we'll see how that plays out. It doesn't happen specifically if the economy is just fine, because it's kind of like nobody ever has to learn the lesson or get the downside from incredible monetary actions. But I think we have to watch that one. And then there's the fear of the ugly. And this is sort of the overhang on the surprising strength, right? So we have this data, things are looking okay. We're chugging along. So far, rate hikes aren't hurting too much. Okay, maybe we should buy some base metals. We should invest in growth, I don't mean investing type growth. I mean, in stocks based on economic growth, maybe we should do this. But then there's this overhang, which is that at some point, rate hikes do have to drag on the economy, right? That is what they are there for. And inflation has not yet been slayed. Yes, it has come down, and that is great. I mean, I much prefer 5.5% inflation over 8% inflation, but 5.5% is still too much. And the sticky parts of inflation are showing just how sticky they can be. In the latest inflation print, those were annoyingly sticky, for sure. Services inflation continues to increase. That brings us right back to that conversation about wage pressures, right? If wage inflation sets in, and wages are a big part of services, and so if service inflation continues to rise, you expect that to feed wage inflation. That drives overall inflation. This is what has not been slayed yet. The inflation question has not been answered, which means that we're going to see more rate hikes. How many? I don't know. 25 basis points for the next 3 meetings seems, from where we stand today, like a very likely scenario. At some point, those have to start to drag. And so the fear of the eventual recession, the shoe has to drop at some point, that will create an overhang on the base metals market to whatever extent it can get going in this surprising strength. It will create a bit of an overhang. There's pros and cons to that. I think that overshadow, the worry about what is to come, is good for gold. That supports gold come what may, but it does create a bit of a drag on the base metal situation. Now, at the beginning of the title of this was about bullish fundamentals for metals. I don't need to spend a lot of time on that with this audience. I mean, there are incredibly bullish supply-demand fundamentals across a bunch of metals. And those, I like to remind people, come from three things that have transpired over the last decade. And those three things are management teams at major miners turned uber conservative, right? They bought projects that they shouldn't have bought, and they wasted oodles of money in the last bull market, and then they actively turned conservative through the bear market, and up to very recently, they focused very much on profit. I mean, good thing really to focus on. Profit, share buybacks, dividends, all of those things. They did not invest in growth, in output growth, okay? So conservative management at major mining companies, lack of investor interest, so that if there's a bunch of investor interest, that motivates management teams to start building mines, but that's not the situation that we were in, and ever harder permitting. If you were one of the management teams that did want to build a mine and you managed to find investors who were interested, you still need in general to spend a decade on the, if you're lucky, in a lot of places to permit a large new mine. So those three things have conspired. Those are the reasons that we don't have enough mines to feed demand, which is only going higher, that's going higher, accelerated because of the green transition, right? So silver and copper and nickel and lithium and zinc, these things are all hugely important in the green transition. So we don't have enough. The supply-demand fundamentals are very bullish. That's the way that is. So what do we take from all of this? Unfortunately, I wish I could give you sort of an ironclad thing to hold on to going forward. The only thing that I can give you in that sense is that the data will continue to matter. We are in this situation of surprising strength. While we are here, I think gold will be supported because of that worry of when the recession will come. But I think base metals have a chance to get going here, because as long as the data looks good, then investors will say, well, we'd better invest in what is, not in what might come at some point, but we've talked about it for a year and a half and it still hasn't come yet. So I don't think we should start investing in it yet. I think we are in a situation of surprising strength. We need to accept that that's where we are, but we need to watch the data because it could change at any point. I'm finishing with this slide, which is specifically pointing out that indicators suggest we might be fairly close to that tipping point. This slide shows past patterns for housing on the top, manufacturing, and then consumption, personal consumption on the bottom. And they always go in order ahead of a recession. So first you have a downturn in housing, then you have a downturn in industrial production, and then you have a downturn in personal consumption. And that's when the recessions happen, is when you have bam, 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 things are bad. And look at that. That's what happened back in 2009. That's what happened back in 2001, back in 2009. And we have two of those three indicators lining up right now. So the shoe could drop at any point, but where we are right now is that the shoe is not in sight. So the data will continue to very much matter. If we continue to see strong data, then base metals will have a real chance to go, and there could be some interesting moves in base metals over the next 6 months. Like really, this could light up. But if you start to see the data turn down, remember, that's the other shoe. It's coming, and we don't know. Then we'll get to jump back into the hard versus soft landing debate, as if we haven't had enough of that. But that's what will come at some point. But I think it's important to live in the moment. The moment is one of surprising strength, and there's some ideas for metals investors in that. This is what I do. I write a weekly newsletter about what I'm buying, selling, and thinking in the metals and mining space. I also have a premium service for those who are interested in what financings I am investing in. And I have a new newsletter with my partner, Peter. Evergreen Investing explores the massive investment opportunities of the green transition. And that's not ESG, because we find that too nebulous. This is the inputs and innovations that are required to make this paradigm shift a reality.